This is a weekly time frame chart of Bamal lorry, and you see this nice cup with handle here. So I will draw it for you. You see, nice cup with handle. Only one candle in the handle, so this is the pivot point. Okay, so that's the cup with handle which was marked on Market Smith. I think the relative strength of the stock uh, was at the time was 50. So I will come to that. Okay, not doesn't fit our criteria, but it was marked as a cup with handle with base count as 1. Okay, so the high of this is 164.90. That was the pivot point. 164.90. That was the pivot point, and this was just before 4th of December 2023. So this is an old chart. So as per the SEBI regulations, we are allowed to discuss this chart is because it's more than 3 months old. So this is 4th of December. Let's see on the daily time frame chart on 4th of December, what was the situation of the moving averages. So for this video, I am showing you a bar chart. I think probably for the first time on my channel, I am showing a bar chart, that too on the daily time frame chart, just to keep it simple for those of you who do not understand candlestick chart. But have a look at this 4th of December. Okay. Blue, green, red. The price is above the blue, green, red. The price is above the 50 day. The 50 day is above the 150, and the 150 is above the 200. Although the 50-day is sloping down, but that's fine. That's not a rigid criteria as long as the price is above the blue, green, red. And we have the blue, green, red combination. It fits our criteria. It's a stage 2 confirmed uptrending stock. Now, if I were to look at this stock, I would not have bought the stock. One, because there is a falling window here. So falling window becomes resistance. Okay. So this is the falling window here, and then here. That range, that yellow band could become resistance. So I would not have bought that stock. That is one reason. Another reason I would not have bought the stock is because of the relative strength. At the close of this weekly bar, the relative strength of the stock was 5050. And as per William O'Neill's book, we are not supposed to buy stocks with a relative strength of less than 70. Okay. Have a look at this base. 1, 2, 3, 4, 5, 6 red candles inside the base, all 6 coming on low volume. So it's a good base. One problem with the base is that the pivot point is not in the green zone on the weekly time frame chart. So if I draw the base on the weekly time frame chart, see, the pivot point doesn't come in the green zone, and on the logarithmic chart, this red zone might seem larger than blue and green combined because it's a logarithmic chart. It is not an arithmetic chart. So you might think that the red zone is larger than blue and green zone combined, the height wise. You feel that on a logarithmic chart. But you see here, the buy point doesn't even come in the green zone. Now, green zone closing is not a criteria on the weekly time frame chart. We don't want green zone closing on the weekly time frame chart. What we want on the weekly time frame chart is a clearly marked pivot point, a clearly marked pattern, a clearly marked pivot range of 5%, the blue shaded area, a clearly marked green shaded area, which is the selling zone, and a clearly marked red shaded area, which is the stop loss zone. Once we have all of that, we are ready to take the trade. Okay. However, just to be extra conservative, assume that there is a bar on the weekly time frame chart which goes inside the green zone and then comes back down, and then the stock consolidates for 2 3 weeks. That would give us a pivot point on the weekly time frame chart. It would not give us a closing in the green zone on the weekly time frame chart, but at least it will give us a pivot point on the weekly time frame chart in the green zone. Okay. That is conservative trading. Here you are buying it from the blue zone. So that is another reason I would have rejected the stock. Poor relative strength, falling window on the daily time frame chart, and the stock is coming out of the pivot from the blue zone on the weekly time frame chart. These are the three reasons, more than enough to reject the stock. Okay. After you reject the stock, look what happens. Starts to go up. Let's see how far it goes up before it starts falling. Yeah, here it starts to fall. Okay. Let's measure the distance from the pivot point here till the high of this bar. It went up 76%. Okay, so you might say, Rohit, you missed that 76% return just because of the relative strength, the falling window, and the blue zone pivot point. You rejected the stock, but the stock still went up 76%. How could this happen? And how could you miss such a great opportunity? All throughout the stock remained above the 10-week simple moving average. How could you do that? Well, I will give you an answer. Try buying 10 stocks with a relative strength of 50 or around less than 70. Try buying 10 stocks and tell me what is the effect on your portfolio. Okay. Try buying 10 stocks which have a falling window inside the base and tell me how it feels in your portfolio. Or try buying 10 stocks coming out of the blue zone on the weekly time frame chart and tell me what is the effect on your portfolio. I have been telling you that trading is a game of probabilities. Just because one stock goes up 76% with a relative strength of 50 before the breakout does not mean that all stocks with a relative strength of 50 will go up 76%. That does not happen in the stock market. There is a randomness in the stock market. Even though the relative strength is low, the stock shot up 76% does not mean that you start buying stocks with a relative strength of 50 or more. If you try to do that, you will end up buying stocks with poor relative strength. There will be other stocks that will be doing better than this particular stock. So you have to look at the stock market from a series of trades perspective, as spoken by Mark Douglas in his book Trading in the Zone. Don't look at one particular stock and jump to the conclusion that I will now onwards I will start buying stocks with 50 relative strength. Try doing that and tell me how do you feel. Uh, Tell me how what is the effect on your portfolio. Okay, that is what I wanted to discuss with you in this video. Sometimes you will miss huge opportunities in the market just because the stocks don't fit into the criteria. That does not mean that you start compromising on your criteria. Okay, you have to be strict in the stock market with your criteria because the market is not there to give you money. The market is there to take your money. Be strict with your criteria. Stick to your standards. Don't compromise on your standards. When the stock comes in your criteria, take a decent amount of position size. Put a reasonable stop loss. Take book partial profits when the stock begins to go up and manage the trade with a 10-week simple moving average. That is the best you can do in the stock market. But if you start cutting corners, if you start becoming lenient, if you start compromising on your standards, the effect on your portfolio is not going to be positive, because if that were the case, everybody would have made money in the stock market. Thank you so much.